Good morning, everyone, and welcome to the Moneycontrol live stream. You're watching another edition of Markets with Santo and CJ. Well, apologies for the delayed start. We were facing a little bit of technical issues. Maybe Santo and I were trying to polish our arguments, as one of the comment viewers said on the comment. That could be possible, but it was largely actually due to technical issues. That said, well, the cement sector will be in quite a focus today after the industry leader UltraTech came out with the second quarter results yesterday. And Santo, today in the spotlight, we are putting UltraTech, probably because some of the commentary that has come in from the management after the results in a conference call. Now, if you look at the earnings per se, the earnings are surprisingly good. I mean, if you look at the top line number, the bottom line number, they were all much ahead of what analysts were expecting. But if you look at the commentary or guidance that came in, they said that they are going to be posting double-digit volume growth. Double-digit in corporate slang basically means more than 15-20% at least in my estimate. So that is what they are indicating. They are indicating a double-digit volume growth.
Sorry, CJ, double-digit starts from 11%.
I know, but
10%.
Analysts always say
11 there is high double-digit, low double-digit, mid-double-digit.
High teens, low teens, and mid-teens, and then they go to double digits.
Yeah.
Anyway, so UltraTech's basically point of view is that they are going to have double-digit volume growth in FY23, which is this year, this financial year, and FY24 as well, on the back of what they feel is a very, very strong demand environment. Apart from that, on the cost side, which has been a major talking point as far as cement industry is concerned, they said that although fuel costs have peaked at this point of time, if you talk about crude oil, if you talk about pet coke, but they are likely to stay elevated, which might be a little bit of a disappointment for a lot of people who are expecting that because of the sequential decline in crude oil prices, that benefit could accrue into the margins going into Q3 and Q4, Santo.
Well, if you look at the two major cement numbers that have come in so far, one by ACC and Shree Cements before this, those two were hugely disappointing, and the margin pressures have been evident in the case of UltraTech also. That said, this quarter is going to be very critical because the market appears to be pinning hopes on a strong growth in demand. Now, the September quarter number hasn't come as a big surprise because for two factors: A, offtake is low during the quarter, and also then the elevated raw material prices, because cement companies typically keep some bit of inventory. So you obviously going to see the effect of the high cost raw materials press on margins. But this quarter is going to be critical, and CJ, I don't quite buy that argument about not having to worry about excess capacity in the market. That's pretty much a threat, and at some point I think excess capacities will start weighing on margins. And so all said, I've not been a big fan of cement sector, but if you were to take a bet on the cement sector, then probably it makes sense to go with the market leader, and that is where I think probably UltraTech will continue to do well, because it's still clearly been an outperformer in the cement sector so far.
Well, Santo, your point of view about excess capacity was, of course, one of the most asked question to the management yesterday, and this is the management's response to that, and why I feel that probably UltraTech seems to be a little unfazed by the entry of a new player in the industry, which is Adani Enterprises. They believe, or UltraTech's management believes, that at this point of time, if you look at effective capacity in the industry is actually quite lower than the total capacity that everybody keeps tracking. That is why, if you look at demand over the next 5 to 10 years, and then you look at current effective capacity, whatever excess capacity is going to come into this industry is going to be absorbed very, very quickly. And that is the point of view that UltraTech has, and one of the reasons why they went on to announce the large capex that they did not so long ago. I think their point of view is that in a growing market like India, where we have not yet reached a level of point of saturation in terms of demand, any sort of good capex or good capacity that comes in, which works at full utilization, will easily be absorbed by the market. Apart from that, another surprising thing that the management said, Santo, is the fact that they believe that pricing, there is no reason why prices should not edge higher in this industry. Given that the demand outlook is so strong, and given that effective capacity at this point of time is much lower than what a lot of people assume it to be, therefore pricing improvements or pricing power should in fact return to the industry over the coming quarters. And that is why one of the reasons why they are so bullish on the fact that their working capital, which jumped this this quarter, which can be also be visible in the overall outstanding debt that has also increased in this quarter, that working capital will come back into negative territory, even though they have been consciously adding a little bit of higher cost inventory, as you mentioned, Santo.
Well, fair points there, but a couple of quick points I would say, CJ. One is that this capacity factor, the cyclical factor of cement industry is not going to go away. In the past also we have seen that more capacity comes in, demand doesn't keep pace, and then you see the overcapacity that ultimately weighing on prices, and then lack of discipline among the players. This won't really go away. This is a fundamental part of the cement cycle, and this will continue to be there. And the whole thing that why cement prices shouldn't go higher, that again is a function of demand. Now we are hoping that demand will be very strong in perpetuity, but I would be slightly skeptical about that, having seen quite a few.
I think not perpetuity, Santo, but at least if you look at this decade, I think given the fact that there is a lot of strong hopes of a new demand cycle, I think this decade could be a good decade in terms of demand.
Yeah, so with that, the market has opened. The breadth is negative, and main indices are also under pressure at this point in time. The Sensex down about 225 points. Nifty Bank is down close to about 0.7%. Nifty down 80%, pretty much in line with what the SGX Nifty was.
Yeah, and Santo clearly, driven by the negative handover from Wall Street that we saw yesterday. Wall Street ended largely lower. A lot of the benchmark indices there ended largely lower on the back of very weak earnings from Abbott, which ended up offsetting the strong numbers that we had seen from Netflix actually. Apart from that, I think what is happening in the global currency market is also taking a toll. Rupee today opened at another fresh record low, clearly on the back of very weak global cues. The last hour sell-off that we saw in the rupee dollar Santo yesterday, I think that has spooked the market at this point of time, and it will be very interesting to see how we get into the tomorrow's trading session, given that we have the Mohra trading session on Monday.
Well, at this point, I would say that CJ, the weakness in the rupee and rising interest rates, these are the two big concerns for the market. Although you may not see a sharp downside, overall sentiment still is maybe cautious, but it's definitely not bearish at this point in time. But the big upsides, typically which you see around the festive season, that probably could be kept in check. That
possibly, and just to add a caveat, a lot of people wonder whether it is the rupee that is weakening or the dollar that is strengthening. And I think in our case, it is largely that the dollar is strengthening more compared to the rupee, because if you look at rupee against some of the other currencies such as the euro, yen, and yuan, Chinese yuan, rupee has actually considerably appreciated against those currencies. So given the strength or the inherent strength of the economy at this point of time, given the fact that we will probably be the fastest growing large economy in FY23. I think, Santo, there is a lot of comfort still, even though the rupee is hovering at record lows. I don't think it is all panic stations at this point of time as far as the equity side of the investment is concerned. That is why we did not see a very negative reaction today, although today's reaction, I think it seems to be more in line with what we have seen globally.
Well, and with that, let's head into the newsmakers section, starting with Metro Brands, CJ.
Well, Santo, the stock will likely be in focus today after very, very strong results from the company. Now, this is a stock that was, backed by the late great Rakesh Jhunjhunwala. And if you look at the second quarter sales number, 47% year-on-year growth, along with an operating profit growth of about 52% on a year-on-year basis. Clearly, very, very strong numbers. The company has benefited from, the return to offices, the return to school, drive that we have seen post the Omicron wave. Apart from that, a very interesting acquisition also from the company. The company has acquired Cravatex, which is basically operator of Fila brand of shoes, in the market. Now, this basically marks Metro Brands' entry into the athleisure market, Santo, and we have spoken about this market in the past as well on this show when we talked about Campus and Relaxo, and this is one market where it's in the high margin products. You have high margin products, and therefore if you can gain market share here, your margin profile also immediately improves quite sharply. So I think one stock to watch out for today.
Well, Havells is the stock I have on my watch list. Now, the numbers were pretty disappointing. The numbers both, if you look at every major parameter, be it revenues, be it net profit, be it operating margins, all have come way below what the market was expecting. And this is all the more glaring, CJ, because a rival like Polycab has managed to come out with very good numbers for the second quarter. So this will be seen in context of Polycab's earnings, and that probably could lead to the stock coming under pressure this morning.
Well, Santo, moving on, our hot brokerage bets for the day, and starting off with Polycab India, as you mentioned, good that you mentioned it, because as you said, the earnings performance of the company was actually very, very strong, even though the business environment was actually not doing quite well. If you look at the cable wiring segment, that is one segment where there was a lot of pricing pressure, there was a lot of input cost pressure. So clearly the company has managed its earnings performance quite well. And if you look at what brokerage from ICICI Securities had to say, they believe that even despite the weakness that we are seeing in the business environment in Q2, they expect the company's sales to grow about 15% on an annualized basis, and the company's net profit to grow at 28% annual run rate over the next 3 years. That is one of the reasons why ICICI Securities still has a hold rating on the stock, even though the general environment for the business has deteriorated, and it has bumped up its target price to 2,700 from about 2,200 odd earlier. That said, ICICI Securities, Santo, has a note of caution for the investors. They believe that at this point of time, the valuations of the company are currently factoring in most of the positive, and therefore any upside at this point of time could be limited.
Well, I think that last part holds true almost for 80% of the stocks right now, which have been doing well.
It is not true, Santo. It is not true.
But anyway, I mean, valuations are always a
debating topic.
Yeah. Canfin Homes, that's the stock on my watch list. Edelweiss has a buy rating on the stock with a price target of 720 rupees. Now, the second quarter numbers were better than what the market was expecting, and that leads one to believe that the concerns which most investors would have had about asset quality and all the fraudulent transactions which had happened in the company, those may have been overdone. The company has guided for a net interest margin of 3.5% over the next few quarters. It's given a guidance of 18 to 20% for growth in assets under management. Now, Edelweiss has also cautioned that there will be some amount of uncertainty over the new management strategy, that the market will wait for that, which is why you're not seeing the stock immediately bounce back to the recent highs.
Yeah.
The market is still quite guarded in its response to the latest numbers, but overall Edelweiss has maintained its buy rating on the stock, though it has cut the multiple slightly.
Well, that's the Santo time for our stock takes and hot takes on some of the stocks that we feel would be on buzzing in trade today, and starting off with a small banking name.
Yes, AU Small Finance, the net profit number was way ahead of what analysts were expecting. Loan growth was pretty strong, close to about 44% growth in the loan book. Higher lending rates also helped because a significant portion of the book is on a floating rate basis, and lastly, loan loss provisions were also lower. So these three factors helped AU Small Finance Bank post a good set of numbers. Now, the main growth drivers were the segments which contributed the maximum were commercial banking and the home loan segment. The management's focus, according to MK, is now on improving the net interest margins, managing it at current levels, and also growing the base of retail deposits, which at this point is fairly high, but the company is still trying to improve that further, because if you lower the cost of funds, it always means that your profits will be much higher.
Well, Santo, I think if you look at the top line number and if you look at the loan growth number, clearly the company has seen a lot of improvement in the second quarter. But if you look at the operating profit number, I think that is where there is a little bit of a disappointment coming in. Brokers are aware of the view that the growth in operating profit was a little modest compared to some of his peers out there in the second quarter. Apart from that, one of the reasons why the operating profit growth was modest is because there has been a significant jump in operating expenses for the company, and I think that is largely down to the higher cost of borrowing that the company is facing at this point of time because of higher interest rates, as well as the fact that they are expanding very aggressively, and therefore marketing costs are going up. That said, Credit Suisse is of the opinion that the premium valuation that the company has been enjoying vis-a-vis some of its peers like Ujjivan Small Finance Bank, that could start to contract going ahead, given that loan growth will probably be in line with a lot of the peers out there. Because if you look at the guidance, Ujjivan is also expecting somewhere around 25 to 30% sort of a loan growth in FY23. So therefore, there is not many reasons why this stock should be outperforming some of its peers at this point of time. Well, the first stock on my radar today, and the last as well, is IndusInd Bank. Stellar numbers. If you look at the operating performance, if you look at the return ratios, you look at a net profit, it's been a very, very strong show, and it has been a continuation of the trend that we are seeing from IndusInd Bank over the past few quarters now. Net interest margin in the September quarter surged to a 9-quarter high of 4.24%, benefiting, it seems, from the higher interest rates at this point of time that banks are enjoying on their loans. Apart from that, the lender also saw the best year-on-year loan growth in 11 quarters. That is more than 2.5 years at this point of time. And the scope for that growth to accelerate even further is very, very high, Santo, because we are just at the very early stages of a new credit offtake cycle in the economy. That said, Santo, you always harp about valuation, and IndusInd Bank is one of those banking names which has done quite well over the past year. But JP Morgan believes that actually at this point of time, valuations are still very, very undemanding, and therefore, I mean, this is one stock to look out for if you're a long-term investor who is quite bullish on the banking space.
The other way of looking at low valuations is the market's reluctance to buy into the story. That is
sometimes, yeah. So maybe those who are reluctant will now start turning into and become,
yeah.
optimistic.
But that said, see, there's been a considerable improvement in the overall performance of the bank.
Yeah.
That much is very evident. There were huge concerns about the asset quality, especially on the corporate book side. Now those have abated, but at the same time, it does appear, if you look at the price chart, CJ, it does appear as if the market is again undecided. There's been some bit of historical issues there. The market is still trying to come to terms with that. Stock topped around 1200 rupees in November. Since then, it's been in a range. It's fallen sharply, but then rebounded quickly. But at the same time, it somehow seems to be struggling to stay above 1200. Once that level, maybe it's technical factors at play. Probably once it breaks past that level, maybe you might see some kind of renewed buying setting in there. But as far as the perception of the stock is concerned, definitely now the kind of concerns that were there till some time back, those are not there.
Yeah,
but it's just as if the market is waiting to make up its mind. The core portfolio of the bank is anyway doing pretty well at this point in time. Last stock on our watch list this morning is Mahindra CIE, auto ancillary stock, and the stock has almost doubled from the lows it had tested in March. It had fallen to as low as around 165 rupees. It's almost now quoting at close to 320 rupees. Decent set of second quarter numbers, and most importantly for an auto ancillary company, most of which have been reporting a pressure on margins, Mahindra CII has managed to maintain its margins around 12%.
Impressive.
The company has said that the outlook for its European business, Europe is a major chunk of its revenues, and the outlook there remains quite strong. And most importantly, the company also has a clause whereby it can pass through the higher energy costs to its customers. And as far as the India business is concerned, the company is aiming for a 10% growth out here. And according to Motilal Oswal, order wins in the EV portfolio, probably that could be a major re-rating trigger for the stock.
Well, Santo, no doubt that it's been a very resilient performance as far as Mahindra CII is concerned in the September quarter. But I just feel that the EU business, that European business, will remain a big overhang on the stock performance going ahead, because at this point of time the fear is that the situation in Europe is likely to deteriorate even further. I don't think we have seen the worst as far as the economic slowdown and recession and the energy crisis that everybody has been talking about there, and therefore I think the cost pressures that Mahindra CII will face, even though it can pass on almost 60 to 70% of that to the clients, I think could be still quite high and could weigh on earnings going ahead. Apart from that, if you look at the the rebound that the stock has seen from the May lows, it seems like I think this is a good point of time where the stock could enter a little bit of a consolidation phase. Some of the short-term investors might look at taking some bit of profit at this point of time, given the fact that some of the momentum indicators also are at this point of time edging towards the overbought zone, and that tends to be a good trigger for short-term traders to take some profits on the stock at this point of time.
Well, any questions you would
Well,
like
Santo,
to
yes, we do have a very interesting, actually we have a lot of interesting questions, but one of the questions that really stood out for me from our viewers today is from Vishal Singh, who asked, why has the US market dropped about 17%, whereas the Indian market has only dropped about 3%, Santo, in the past 6 months, and what does this mean for the Indian market?
Well, short answer, Vishal, there's chatter of recession in US is growing stronger. The outlook on the economy at this point in time is fairly bearish, and which could partly explain why US markets have corrected so much, because the economy in the slowdown clearly means that corporate earnings will be affected. Now, while Indian economy is also showing some signs of slowdown, the situation doesn't seem to be so bad. At least if you just look at the inflation in US as well as that in India, the problem seems to be much dire in US, where the interest rates, as a result of high inflation, the interest rate hikes have also been pretty sharp. So high interest rates is always bad for equity markets, at least 9 times out of 10. You will have some, this time it's a bit of an outlier that you're seeing, where high interest rate is not really dampening the appetite for Indian equities at least. But in theory, high interest rates is not very good, and since you've seen rate hikes in the US at a much faster rate, probably that's why you're seeing the stock prices there under pressure and not so much in India, where the earnings situation still looks reasonable, and the fact that India is doing better than other advanced economies is making more foreign institutional investors also put money into India, besides the domestic investors who seem to be very upbeat on India.
Well, Santo, one point of caution on this, Vishal, is the fact that when you're outperforming one year, it is very much possible that you can start underperforming the other year when other markets become relatively, cheaper. Because if you look at India at this point of time, India is trading at more than 20 times 1 year forward earnings. If you look at China, which seems to be at the bottom of its current economic cycle, is trading at less than 10 times. The entire emerging market basket is trading at less than 9 times, which is historical lows as far as 1 year forward PE multiples are concerned. And therefore, a lot of investors will start questioning whether they can make more money investing in those markets because of the upside or mean reversion that could happen there, compared to India, which is already at a near record highs in terms of at least valuation. So I think it works both ways. This year, maybe India was the haven for a lot of investors, given the fact that a lot of the other markets were taking a hit. But next year, the story could very easily flip, as one could see in the BofA Securities FMS survey. There, a lot of fund managers at this point of time are looking to go underweight on India, Santo, next year, whereas they're looking to go overweight on markets like China, markets like emerging market, and the entire basket, and some of the markets in Eastern Asia, such as South Korea and Taiwan.
Well, and with that, it's a wrap on this edition of Markets with Santo and CJ. Thanks for watching, and please continue to send in your questions. We'll try to answer them to the best of our knowledge.
Yes, and as usual, guys, keep following us on the social media links that you can see at the bottom of your screen. And for the rest of your financial news, stay tuned to moneycontrol.com and download the Moneycontrol app. We'll catch you again live at 3 p.m. We promise there will be no delay, definitely. Till then, have a great trading day.